Hey everybody, it's Mike Weller with the Weller Group at Keller Williams Realty. It is April and we have a new feature for our monthly newsletter here. We're doing our monthly mortgage moment with Momi, with my friend and colleague Momi Pointer from Arbor Financial. She's one of the top lenders here in Orange County. Hi Momi, thanks for joining me today.
Good morning.
And we were going to talk, every month we're going to talk a little bit about what's going on in the mortgage markets. And right now, obviously with the coronavirus and COVID-19 and what's going on with the economy, there's been definitely some changes in lending, hopefully temporarily. I think temporarily. We'll talk a little bit more about that. But one of the questions I keep getting, and Momi and I were chatting off the air a little bit, and she's getting the same kind of feedback, and I think a lot of realtors and a lot of lenders are. People are asking us like, hey, are prices going to crash? Like, is this, is the real estate market just going to go down the drain? And, none of us have a crystal ball, but I really don't think so. I think a lot of people, their frame of reference is 2007, 2008. And that's when real estate prices crashed. And, keep in mind, real estate and lending, bad lending practices really caused that whole recession. That was a real estate and lending created recession. This time around is a little bit different. I mean, what's going on in the world really has nothing to do with real estate. And on the real estate side, I don't see us going from a low supply, low inventory market to having 1 or 2 years of inventory, in a short period of time, like what happened in 2007, 2008. Momi, you have some thoughts too on, how this is very different than '08. So tell us about that from a lender's perspective.
Yeah, from a lender's perspective, I agree with you, Mike. 2008 really had to do with bad lending practices, bad loans in general. The way that I feel now is, I keep getting asked, is there going to be a bubble burst? Are we going to see, prices go down? I think there might be a slight dip in prices, and you can speak more to that, but it's not going to be long lasting, like you said, for 2 or 3 years. I think now is more like, maybe more like a punch to the gut, as opposed to like '08 was like a wrestling match and who was going to win. Were the banks going to win? Was lending going to win? Were the consumers going to win? This was obviously unprecedented and sudden. A lot of people are unemployed, which was very different than in '08, right? There weren't people unemployed. It just had to do with bad loans and people losing their homes. Right now, we just have a lot of people unemployed.
Right.
What was your other question? I'm sorry.
No, I mean, that was it. I mean, we eventually did have pretty high unemployment in, as we got to 2008, 2009, but that was initially all caused by lending and foreclosures and, people losing their jobs. That was really the result of the lending. So here we have, just big segments of the economy shutting down temporarily for public health and safety. I think a lot of economists expect most of those jobs to bounce back pretty quickly when we can open. Again, none of us have a crystal ball, and I'm not saying the economy is going to be all rosy, but if you go back and look historically at recessions, real estate doesn't necessarily take a hit or a big hit during recessions. The last Great Recession was very different, but that's the frame of reference that most people have in their minds. So but tell us what's happening now in lending. I know some borrowers and some loan programs are very, very much unaffected, and other borrowers and other loan programs are quite a bit different than they were, 3 or 4 weeks ago.
Yeah, it seems like an eon ago. It's only been like 2 or 3 weeks ago. So what's happening in the lending industry is, for loans that don't fit in the box. So your straight W-2, your primary residence borrower, your loan amounts from 510 to, I believe it's 765, high balance in Orange County. Those loans are fit in the box type of loans, as opposed to, like, I'm sure some of you have heard, there were the bank statement loans where you take your bank statements and, you can derive your income. Those have pretty much gone away. Lenders have really pulled back on those programs. Lenders have really pulled back on jumbo programs. I still see rates really, really low. What are you hearing, Mike, as far as rates? I'm still seeing them low.
I know they were very low. Then they went up a little bit a week or a couple weeks ago or so.
Mm-hmm.
They're kind of low, but I'll defer to you. What do you think is going to happen with interest rates? What's going to happen going forward? That's a question a lot of people are wondering about.
Yeah, I think, well, my crystal ball is only halfway charged.
Okay.
But what I will say is I think rates are going to remain low. And the reason I say that is because, again, like you mentioned, this is not just the United States. '08 was the United States. This is global. This is worldwide. Mm-hmm. Everybody's, in this, as far as the whole entire world and every single nation and all the countries are in this together. And in order to jumpstart our economy, I truly believe the economy will bounce back, as you mentioned. But in order to jumpstart it, we have to keep rates low, because if they start a raising rate environment, you're going to have people that want to buy not be able to buy, not be able to qualify, and we need to get real estate is essential, right, Mike?
It's a huge part of the economy. I think most people realize that, yet I think most people don't truly appreciate how deep a real estate transaction runs in the economy, how many different people it touches, and then the everlasting effects of that home ownership. How many different types of businesses get a positive boost from a real estate transaction.
Well, exactly. And so with it being that essential to the economy, I think that my magic crystal ball says rates are going to remain low. We're still going to have people that want to buy. If you're looking in the range of, the conforming loan limit, 500 and lower, which most people would say in Orange County you can't get. But if you have a sizable down, you could get a loan amount of that size. Sure. Rates are really low still. And I kind of want to say that this is just a pause in our economy. It's like a little historical blip, right? It's not going to be long lasting like '08.
Right. Now, when we come out of this, it may not look exactly like it looked a month ago. It may not look exactly like it did on March 1st, but when we do come out of this, I don't think things are going to be as, nebulous or as much of a question mark as they are right now. But so tell me about actually getting a loan process right now. What are some of the challenges that you're having? What are some of the adjustments that different lenders are making? I know appraisals have been interesting and loan doc signing. So do you want to talk about those things?
Yeah. So appraisals, I still have appraisers going into the homes. With some of my purchases, the homes are vacant, so it's not a problem for the appraiser to go into. One of the things I'm going to say that if I have a refinance or the seller still lives in the home, if an appraiser contacts the agent or the homeowner and the consumer doesn't want the appraiser in their home, that appraiser is then obligated to perform a drive-by appraisal. They cannot do a full appraisal. And
the lenders are accepting that, correct?
And lenders are accepting that. I don't know what the difference in cost is, because I actually haven't seen a drive-by yet. Most of mine are still full appraisals, right. But lenders are and have to accept drive-bys. As far as notaries, I still have notaries going out to borrowers' homes. I had a borrower who just signed loan docs the other day, and they signed in the garage because they have young children, and they abided by the 6 feet social distancing. Right. They set up a table for them and set up a table for the notary. I do know that some of the professional associations in the lending industry are reaching out to the CFPB to possibly get e-signing or docu-signing for loan documents, for the actual loan documents where you would normally have a notary present. Right. I haven't heard anything yet on whether they're going to move forward with that.
Yeah, no, I think there's a lot of, with everything going on, I actually think there's a lot of little side benefits and a lot of positives that will come out of this. And one of those things is that I think this will accelerate a lot of progress in a lot of areas where we were moving slowly towards something, just like people working from home. I think this will accelerate the number of people that are able to work from home effectively. So that the electronic notary signing is another perfect example. I think this, that's something that I easily could have seen happening 10 years from now anyway.
Yeah.
But this could very much accelerate that, by sometime 6 months from now, that could be a regular thing. And I think that's, anything that makes the entire process a little bit easier for the consumer is a win. So hopefully that's what happens here.
I wonder if we could do notary Zoom meetings.
Well, it might look something like that.
Yeah.
The notary on video, and 15 years ago, if you told people like, yeah, you can sign all of your real estate contracts electronically by email, people, I don't know that too many people would have believed that necessarily. And
exactly.
That's, 90% of the time we're doing signatures electronically. So,
yeah.
Okay, so
can I mention something
absolutely.
real quick, Mike, about the loans that fit in the box?
Yes.
I think it's extremely important for lenders and even myself to really set expectations for the borrower and the realtors if it is a purchase transaction, because think about it from the investor perspective or the lender perspective. They are at capacity right now. That's part of the reason why you're seeing some of them publish high rates, is because they don't want to accept any new loans. So
right.
Right now it's taking, I'll be honest, 45 to 60 days to close a loan. Purchase transactions, obviously, as you know, take priority, right? But it's important for us and you to set expectations for our borrowers that it's going to be along, the turn times are lengthy. Just like us working from home, right? The lenders are understaffed. They have people working from home that maybe aren't used to working from home or don't have all the equipment that they're used to. For instance, like a high volume scanner.
Right.
So I just think it's important that we set expectations, and I think you would agree.
No, absolutely. Absolutely. If I receive an offer on one of my listings and they're trying to make it more attractive and they're writing in a 21-day closing period, and they're financing, that's obviously, something that we're not taking seriously at this point.
Yeah.
Like you said, probably 45 days is more realistic than 30 at this point. And, we have the new coronavirus addendum to help address timelines and extensions in this environment. So yeah, we're pivoting quickly to be able to represent our clients and do business in this environment. So, but yeah, in summary, kind of to wrap up one of the main points that you're saying, if you are, a W-2 employee, getting a conventional loan, things are still okay. That the turn times might be a little bit longer. If you're kind of out of the box a little bit, you're self-employed, you're, a high balance or a jumbo even, you might want to wait until we're a little further beyond this to jump in and, either work on your refinance or realistically work on your purchase, right?
Absolutely. The loans will be back. It's just a matter of time. And with rates still going to be low, I think if you are a self-employed, not so easy W-2 borrower, or if you have investment properties, or it's, more of a jumbo loan, you might want to wait. You just might want to wait. I will mention that there are some additional overlays, even with the W-2 employees, where the lenders are verifying employment initially before you draw loan docs, and right before funding, the day that you fund, and after you fund, just to make sure that you're still gainfully employed.
Right. Yeah.
So.
No, that's very understandable. They're just trying to protect themselves. So. Okay, well, that was a lot of great information in a short period of time. I really appreciate you coming on here with me, and look forward to doing this again next month.
Sounds great. Thank you.
All right. Well, thanks, Momi. If anybody has any questions for Momi, her phone number is here. You can reach out to her that way. You can certainly reach out to me, and I can put you in touch as well. So take care, everybody, and we'll see you soon. Bye, Momi.
Thanks, Mike. Bye.